For the untrained eye, a fast-moving price chart looks like a jagged heart monitor in a state of total panic. Most beginners view these rapid swings as pure noise. They treat the market like a random number generator and end up trading on impulse, reacting to every green or red spike with raw emotion. But these movements represent the aggregate behavior of millions of people. Every buy and sell order leaves behind a specific visual history that we can track and interpret. This infographic organizes that history into a structural guide. It maps out the specific patterns and technical signals that turn raw price data into a coherent narrative. Mastering this visual language allows you to navigate the markets using a clear map of supply and demand. The foundational unit of this data is the candlestick. Each candle represents a time-boxed battle between the buyers, the bulls, and the sellers, known as the bears. Every candle tracks 4 specific price points: where the price started, the open, and where it finished, the close. The thin extensions show the high and low reached during that period. The solid center, or the body, represents the strength of the move. A long body shows that one side maintained significant control and pushed the price aggressively in their direction. The thin wicks reveal a different story. A long wick indicates price rejection, showing that while the market tried to reach a certain level, the opposing side pushed back with enough force to reverse the momentum. By reading these candles, we can see exactly who is winning the struggle for control at any given moment. Zooming out from individual candles reveals the macro direction of the market, which we identify as a trend. An uptrend is characterized by a series of higher highs and higher lows, creating a consistent staircase pattern moving upward. A downtrend is the inverse, defined by a cascading sequence of lower highs and lower lows as bears take control. These movements often respect specific boundaries. Support is the price floor where buyers have historically stepped in to prevent further declines. Resistance acts as the ceiling, where sellers consistently enter the market to cap price and drive it back down. Identifying the current trend and its boundaries is the primary step in determining the market's likely path. To verify what the price action is telling us, we use mathematical overlays called indicators to confirm the strength of a move. Look at the volume bars. High volume during a price swing confirms that a large number of participants are backing the move, whereas low volume suggests the trend lacks conviction. The exponential moving average, or EMA, smooths out price data to show the average trend. When price stays above the EMA, the bulls are generally maintaining their lead. Momentum indicators like the RSI and MACD act as alerts. They signal when the market has moved too far, too fast, and might be reaching a point of exhaustion. These signals are relative to the time frame you select. A chart can show a downtrend on a 15-minute window, while the weekly view shows the price is still in a massive multi-year uptrend. Experienced traders use higher timeframes to establish the overall market direction, then zoom into lower timeframes to find the precise moment to enter. A more reliable trade occurs when the momentum of the lower timeframe aligns with the structural trend of the higher timeframe. When we apply these tools to that chaotic chart from the start of the video, adding candlesticks, support levels, and moving averages, the image changes. The noise is replaced by a structured environment where trends and entry points become visible to the trained eye. However, technical analysis provides a statistical edge, not a guarantee. These tools reflect historical patterns, but the market is always capable of moving in unexpected ways. It is a common saying in the industry that the market can remain irrational much longer than an unprepared trader can remain solvent. Consistent success requires you to combine this visual literacy with disciplined risk management and the patience to wait for the right signals.